This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, April the 6th, 2016. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not specifically updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers' report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk, and in the short term, confidence and sentiment. This month, I'd like to cover a range of topics listed here. I'd like to talk about the recent G20 meeting in Shanghai, China, and what we have come to believe really developed there, something few realize and even few are talking about. If we are right, it is profound and important to your investment thinking going forward and potentially will impact profits in 2016. What we have seen recently is falling corporate revenues, margins, earnings, and cash flows, and we've talked about these. We have seen an imploded global energy and commodity sector crisis, and I use the word crisis. We're seeing liquidity tightening and reverse credit cycle. We're seeing unfunded and unpayable government entitled programs looming as more and more baby boomers retire, 10,000 per day in the United States alone. We're seeing unserviceable household, corporate and government debt levels. We're seeing failed central bank monetary policy initiatives that are just unacceptable to even mainstream investors such as NIRP, negative interest rate policies. And we're seeing heightened geopolitical conflict risks, including Islamic terrorism, an EU refugee crisis, and the looming Brexit. I point these all out simply to say that we have a lot of problems. Any one typically in the past have plummeted markets down while markets still maintain very elevated levels. Look at this world trade chart that I'm showing here. It has collapsed in dollar terms and units shipped. This is as bad and as at the rate that we saw in 2007, 2008. Shipping rates on an unadjusted basis for inflation, unadjusted for inflation levels, are showing here that we haven't seen this since the mid-1980s. In other words, the cargo, there's no money in the shipping business and there's not enough volumes out there. There's a problem in the shipping industry, clearly, and some of the leaders in the industry are describing it as the worst ever and a depression. China is very close to a hard landing and has been forced to implement totalitarianism and economic and regulatory measures, that's the best I can describe it, to stop the fragile economic system from coming apart. Capital is fleeing China while its investment and export-led policies are simply failing. In the short term, they have some major adjustments and major problems that they're going to have to correct. Forced selling by China of its U.S. treasuries is a major problem for the U.S. deficit. We have become dependent on China buying our treasuries, bills, bonds, and notes to finance our debt. And as we can see, China needs money right now for various reasons, and they're actually reducing their reserve levels. That reserve levels were money that was typically held in U.S. treasuries. German Finance Minister Wolfgang Schäuble was very, very clear at the recent G20 meeting that Germany is against the world's top 20 economies launching a fiscal stimulus package in the face of slowing global growth. And he attacked, in many ways, a lot of the policies that are going on around the world. It was the only thing on the surface that came out of the G20 session. Governments, he said, are attempting to boost their economies with monetary loosening, which could be counterproductive. Reforms were more important, and thinking about further stimulus, he felt just distracted from the real task at hand, what they should be focused on. And Berlin does not agree with the G20 fiscal stimulus package. And I quote, monetary policy is extremely accommodating to the point that it may even be counterproductive in terms of negative side effects. Fiscal as well as monetary policies have reached their limits. If you want the real economy to grow, there are no shortcuts without reforms. He couldn't have been any stronger, any clearer, and that was the only message we got from the G20. Currency manipulations are a negative-sum game. One country can get a small temporary boost from devaluation, but trading partners are worse off, and the world is worse off. Ultimately, even the country that devalued first is worse off after others retaliate. From the Shanghai meeting, what I really got out of it is what James Rickards has pointed out, and I interviewed James Rickards here recently, and he was very clear and quite strong on this, and he's a well-acknowledged leader in his book, Currency Wars, his involvement with the CIA and consulting in terms of cyber warfare. He is very much a student of this. He's he's had personal meetings with Ben Bernanke. According to Jim, he says, and I quote, a new theory of currency manipulation was created by Ben Bernanke. This theory says that if every country eases at the same time, everyone gets the benefit of the easing, but exchange rates don't change much because of the coordinated timing. Bernanke called this, and I quote, enrich thy neighbor, end of quote, in contrast to the original beggar thy neighbor name given to the currency wars in the 1930s. So Bernanke has had this doctrine that we've referred to it as rotating central bank policies of ring around the rosies of currency debasement. The concept of cooperation and coordination among the central banks can be carried several steps further. Several countries can ease or tighten at the same time in order to give one country some relative benefit by design. Central banks can give targeted relief to one country if they all cooperate in a secret plan. This is from James Rickards describing Bernanke's policy of enrich thy neighbor. Again, we've called it ring around the rosy that's been going on. So it's formally, or not formally, at least is now being acknowledged as existing by people that would know. Now, let's talk about forward guidance and expectations. The central bank policy changes work through now, at least today, expectations as much as real actions. In traditional policy, a central bank eases by cutting rates or tightens by raising rates, but it can also ease by raising expectations about a rate increase and then doing nothing. If markets price in a rate increase and the central bank does nothing, markets can rally on the news. This is like an invisible rate cut based solely on changed expectations. Having multiple central banks manipulate expectations and coordinate policy behind the scenes is complex. These efforts are doomed to fail, in my opinion, because of unintended consequences and various shocks that will come out of nowhere. But that won't stop the big brains at the central banks from at least trying it. Maybe they have no choice but to try this. China's shock devaluation of the yuan last August was because China had not managed those expectations. They're new at the game, really, frankly, and they don't have the same domestic pressures. This shock destabilized the global financial system, at least partially. It didn't take the system down, but it was a shock. It certainly affected the stock market, as you recall. The IMF and the Fed were quite upset that China was not playing by the rules of the game. On the other hand, China did not care much about the rules because their economy was sinking under bad debts and capital outflows, which have only got worse. China acted in its best interest regardless of the global impact. With this background and the recent yuan shock in mind, the global financial powers descended on Shanghai in late February. The G20 central bankers and finance ministers agreed, and this is according to Jim Rickards, that China needed help. China is the world's second largest economy, and it was falling fast. There was some danger it could take the world down with them. And we've been isolating this problem for quite some time in various reports that we put out. But further, yuan devaluation was not possible, at least in the short term, because it was too destabilizing to the markets. Remember that over 5.5 trillion of currencies is traded daily. Four currencies have dominated this trading for 2 decades: the dollar, the UK sterling, the euro, and the Japanese yen, which we refer to as the currency cartel, because, trust me, they control it in a very coordinated fashion, as much as they can themselves agree. The Plaza Accord in 1985 was orchestrated by James Baker, who was Ronald Reagan's Secretary of Treasury at the time. And this was a major event. It had a lot more visibility than what we're referring to here as the Shanghai Accord. The dollar at that time had increased almost 50% from 1980 to 1985 and reached an all-time high that year. The strong dollar was hurting U.S. exports and jobs. The Plaza Accord was a coordinated effort by the U.S., France, West Germany, Japan, and the U.K. to weaken the U.S. dollar. This sounding familiar? They were the world's largest economic players of the time, and it worked. The dollar fell 30% over the next 3 years. The U.S. economy got a second wind, and the long-term Reagan-Bush expansion continued. Today, U.S., Europe, Japan, and China together represent over 70% of the global GDP. The IMF acts as a kind of facilitator for these secret meetings and was very evidently present at the meetings in Shanghai, and acts as sort of an enforcer for whatever agreements are reached behind closed doors. What was agreed to at the Shanghai meeting? The solution was to weaken the yuan on a relative basis by strengthening the currencies of China's major trading partners, Japan and Europe, Europe being China's biggest trading partner. They did it by raising expectations, those expectations I just talked about. Japan and Europe were the losers in this round of currency manipulations, or at least would be as it was proposed. Japan was the winner in 2013 with Abenomics. Europe was the winner in 2014 with negative rate and the euro quantitative easing. Now it was the turn of China and the U.S. to get a lift. The U.S. and China are the world's two largest economies. If they go down, the whole world goes down with them. Both economies are slowing, showing signs of major weakness. It was time for Europe and Japan to give it up to China and the U.S. That's the legacy of the Shanghai Accord. With Europe and Japan tightening and the U.S. easing at the same time, nobody would focus on the fact that China effectively devalued because the yuan to dollar cross rate would be unchanged. Europe is a larger trading partner to China than the U.S., as I just said, so the yuan-euro cross rate is actually more important to the Chinese economy. What happened under the Shanghai Accord would be a coordinated devaluation that would be unnoticed because China took no official action and the yuan-dollar cross rate was unchanged. It was an invisible devaluation of the yuan. The Shanghai Accord, according to Rickards, and I believe he's right, will be a game changer depending on how hard the insiders push their new playbook. Now, what's happened since that meeting? Just to show you that it is actually unfolding. Since this secret deal was worked out on February 26th, the first chance the central bankers had to put their plan in action was mid-March. The ECB met on March 10th, the Bank of Japan met on March 15th, and the Fed met on March 16th. All three central banks would be able to implement the secret plan in just 5 business days. Now it was game on for the biggest currency manipulation since 1985. First, the Fed weakened the dollar with their dovish comments, which shocked the market on March the 16th. By doing nothing and signaling slower tightening, they changed expectations, which, as we've said, is a form of easing. Markets thought Draghi's ECB bazooka would be long-lasting. What happened on March the 10th? Draghi did the minimum necessary and then said he was done doing more. Shocked the markets. What happened on March the 15th in Japan? Kuroda, the Bank of Japan, was expected to do more aggressive quantitative easing. Kuroda did nothing. Matter of fact, even signaled maybe backing off NERP. Both decisions acted like tightening relative to expectations. They clearly took the markets by surprise. The euro and yen went up against the dollar immediately. Comparatively, the yuan went down with no explicit devaluation by China. This was the new Shanghai Accord in action. The Shanghai Accord happened in stealth, but it will go down in history again, according to Rickards, as a major turning point in the international monetary system. Whether he's right, whether he's wrong, it's clearly something you should watch, and watch very, very closely. And I'll show you a little later some of the charts that have unfolded since I had this discussion with him. The shock waves, if this is the case, will be felt in every market in the world. U.S. stocks will get a lift eventually, though I'm seeing short-term weakness. Japanese stocks will get crushed and gold will soar. The consequence for Asia of a stronger yen and weaker yuan are not difficult to discern. Japanese corporate profits will be hurt two ways. Japanese exports will be hurt because their products will be more expensive for foreign buyers. Japanese multinationals will be hurt when their overseas earnings are translated back into yen. It's a double whammy for the Japanese stock market. Energy in the short term will likely fall because of oversupply and Iran refusing to go along with Saudi Arabia and Russia's oil production cuts. This is to be expected. Probably a double bottom or maybe even a lower bottom. But energy prices will, however, rise if the U.S. dollar begins to sustain downward pressures as a result of the Shanghai Accord. That's what it's after. They want to raise energy prices. They want to decrease the problems in the emerging markets and their debt burden. And also it will contribute to U.S. inflation. I mentioned earlier the charts. The yen and euro will be increased in value together. So if you look at the euro cross, you can expect it to be flat. And that's exactly what we've seen. It's moved into a very flat trading channel, and we suspect it'll stay within a very fixed channel. On the other hand, the U.S. dollar will weaken against the euro. That is, the euro-USD cross will rise. And you can see from the Shanghai Accord, it's been steadily on a rise and has broken what we consider a fairly major overhead resistance level, which signaling some fairly significant more increase in this cross. Well, let's look at the U.S. dollar against the yen. Everybody knows the yen is in trouble, they're going down. Well, that's not what's happening here. The yen is going up significantly. We're at a 14 to 16 month high now on the yen just recently since the Shanghai Accord. And we see it having broken major support on the black line, and we're headed potentially significantly lower here. I do a lot of work with structural momentum over at Momentum Structural Analysis with Michael Oliver, and he has been showing very, very clearly that in regards to the euro futures, that we're at significant overhead resistance, which if broken will take us much higher. And it's every indications are it's going higher. So we're seeing multiple sources confirming that in fact the Shanghai Accord is actually working. I've also recently interviewed, once again, Martin Armstrong. And Martin has some tremendous insight. He's a leader in the world and has been in terms of currencies, and governments actually consult with them. Well, he's developed something called his economic confidence model, which I followed for years and has been surprisingly accurate. It's not dead accurate, but it's generally pretty good for giving overall kinds of major economic shifts and movements. And what I've mapped onto his chart of his economic confidence model is what the Shanghai Accord, when it will work, how long it might work, and what I see is coming as a flight to safety into the U.S. dollar, and then eventually a revaluation of the U.S. dollar as the reserve currency. And the dates I came out were actually through another method, but I mapped them into Martin's economic confidence model, and as you can see here, it's surprisingly telling in how accurate they align up. Maybe they're not exact, but it certainly gives us a pretty good picture to start doing some thinking about. Now let's switch gears a little bit from what the Shanghai Accord is signaling, these charts are signaling, and just go back to the day-to-day charts that I've been talking about here for the last 2 months. The credit cycle turns, in my experience, before the equities. It always leads the equities. It is presently giving a very clear signal. I've written a lot about the turn in the credit cycle since Q4, and I will leave you to revisit the details I previously laid out. The central issue is falling corporate free cash flows and EBITDA levels. That turns a credit cycle around. It has turned, and this market says we're in for a fairly significant adjustment. Tracks back to that first leg down that is expected to really come out of the Shanghai Accord in terms of a weakening U.S. markets short term. We have shown in both the last MATA and GMT report extensive indicators that suggest the U.S. is either already in or very soon will be in a recession, even using government numbers which are becoming, frankly, almost totally unreliable. At times I'm starting to feel even the government's losing track of all the fixes they are continuously putting into their statistics. They just, at times, they don't even make any sense anymore. But they are what they are, and they're telling us there's a problem ahead. A flat and inverted yield curves are historically the most prevalent and consistent indicator of coming recessions, a process of realignment and adjustment. We have watched very closely since Q4 2015 the triple bottom in the 210 U.S. Treasury yield curve. We see that the triple bottom has now been decisively broken, which we've been watching for some time, and we are moving towards an inverted yield curve, signaling the bond market sees economic issues ahead. This all seems to tie together, doesn't it? None of this bodes well for the equity markets in the near term. We fully expect market weakness after tax season is over and we enter the sell in May and go away Wall Street meme that they've used for literally decades. Our 200-day moving average and 400-day moving average boundary conditions served us well during the 2007-2008 financial crisis. They appear to be serving us well again. Bad things happen when the 200-day moving average crosses the 400-day moving average. It is rare and almost always followed by a protracted period within the new directional trend direction it establishes. We aren't quite there yet, but we are extremely close. We had expected prices to minimally test the underside of the 400 EMA as overhead resistance before the long-term top was finally in. This test, which we pointed out in the last report and previous reports, has occurred. It's clearly now has happened. If we shift to the 12-month, 24-month moving average, which we closely watch as a long-term chart, this chart, in fact, going back nearly 2 decades, the message here is blatantly clear from a technical perspective. The question is only how long artificial government pumping can keep this bubble levitated. In conclusion, let me reiterate, I continue to fully expect a Minsky melt-up before all this ends very badly in 2016, possibly 2017. Eventually, it will be clear to all that the central bank policies have been an abject failure. The government policy of financial repression is becoming too heavy-handed as productivity, frankly, plummets. High-paying jobs are disappearing, and tapped-out consumer demand in a 70% U.S. economy is steadily eroding and is, I believe, stalled. So, there are a lot of cross-currents that we can expect that we're going to see. I think you need to understand the fallout of the Shanghai Accord. Watch it closely. It has profound implications. How long they can maintain it, to what degree, is something we'll continue to report on. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2016 be an outstanding investment for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.